By mid-2026, the Adani Group operates as India's largest port operator, its biggest private power producer, and a primary builder of gigawatt-scale AI data centers. This peak dominance comes just 3 years after a market collapse that should have been terminal. In early 2023, $150 billion of the group's market value vanished in a matter of weeks. That wipeout was driven by two distinct crises: a scathing report from a U.S. short seller alleging decades of accounting fraud, followed by a 2024 federal indictment involving a $250 million bribery scheme. Usually, a company facing simultaneous allegations of global fraud and criminal bribery faces a permanent freezing of its credit lines or a total dismantling of its leadership. Instead, the group recovered its value and expanded. Their survival was the result of a specific industrial strategy that traded massive amounts of debt for millions of tons of concrete. Gautam Adani's career began in the late 1970s, working as a diamond sorter before moving into plastics and commodity trading. When India began dismantling its licensing restrictions in 1991, he was already positioned to move goods into global markets. While importing plastics in the early 1980s, Adani dealt with the direct costs of India's choked ports and broken logistics. By the time he broke ground on Mundra Port in 1998, he was betting that owning the gateway to the ocean was more valuable than the cargo passing through it. The company secures a multi-decade government infrastructure contract, using that guaranteed revenue to borrow billions. This funds the massive upfront cost of building power plants and pipelines, which then generate decades of predictable cash to service the debt. The engine for this scale was no longer trading commodities. It was owning the debt-funded physical monopolies that a growing economy requires to function. Adani didn't just build isolated assets. He built an interconnected ecosystem where each arm of the business guarantees the survival of the next. The chain starts at the coast. The group's ports provide the infrastructure to import raw materials at massive scale, specifically millions of tons of coal. That coal is then moved directly into Adani's own thermal power plants, creating a captive supply line for its electricity generation business. The group maintains this growth by mirroring national priorities. As India pivoted toward greener energy and digital infrastructure, Adani followed, building vast solar arrays and data centers right as the government began subsidizing them. This alignment attracts constant criticism. Opponents argue the group's rapid expansion is less about market competition and more about an unusually close relationship. This closed-loop system lowered the cost of expansion, but it also concentrated the group's survival around 2 points: the availability of cheap debt and the stability of its political ties. A business model built on debt requires the absolute confidence of global lenders. In January 2023, Hindenburg research alleged that Adani was using offshore shell entities to hide debt and commit accounting fraud. Within 5 weeks, the resulting panic erased over $150 billion in market value. The situation worsened in late 2024 when U.S. prosecutors unsealed a criminal indictment, alleging the group had bribed Indian officials to secure solar energy contracts. But while share prices were collapsing, the physical infrastructure never stopped. The ports continued loading cargo, and the power plants kept generating electricity, providing the real-world cash needed to keep paying the banks. The legal threat also stalled. By May 2026, the U.S. Justice Department moved to drop the bribery charges, a decision reporters linked to an Adani promise to invest $10 billion in the U.S. economy. Because the group's wealth was locked in functioning, essential concrete rather than abstract software, even severe financial market panics could not physically destroy it. By mid-2026, Adani's listed companies had fully recouped their lost value. Portfolio revenue hit record highs, and the group announced its largest ever annual investment in new infrastructure projects. The result is a study in how debt-financed infrastructure can build industrial scale at a pace that few private companies have ever matched. But it also highlights the risk of tying a nation's foundational infrastructure to a single house. When one company owns the ports, controls the power and the airports, its private controversies become a threat to the wider national economy. The Adani story proves that if you successfully build and own the physical ground a country relies on, you become too deeply embedded to be easily uprooted, even by the fiercest of storms.